All right, everybody, what's going on? My name is Arman Vakili, and this is the Stock Splits Show, the show where we talk about stocks that split. Now, just in case you don't know what that means, a stock split is when a company divides the existing shares that they have into multiple new shares. We'll kind of give you a number so you know what that looks like. Now, typically what happens is that even though the number of shares actually increases by a specific multiple, the actual value of the shares or the value of the portfolio stays the same. So if you have a 2-for-1 split or a 3-for-1 split, and then sometimes they're in some rare cases, they're like these weird splits. But that's what it will look like right here. It would be 2,000. So if you were doing a 3-for-1, let's say, you have 2,000 shares at $300 a share. After the split, your 2,000 shares would each split into 3 new ones, so you would get 6,000. But then because the actual value of the stock is going to change as well, your overall portfolio value stays the same. So your 2,000 times 300 is the same as 6,000 times 100. So in that situation, your portfolio value doesn't change. So why would a company do something like this, right? It says they want to boost the stock's liquidity, which is true, but it's also, there's a few other things that kind of takes place when a situation like this happens. Number one, being that it opens kind of the market up for new investors to look at your stock. This was especially around the time that like these apps that allow you to buy portions of stocks didn't really exist. So you had to actually buy a stock, like an actual full stock, right? So because of that, when you drop the price of a stock, it opens the market up for new investors to come in. And so it helps increase the actual value of the company, the market cap of the company, so on and so forth. And it's kind of like free press, right? Free publicity for the company as well. So moving forward, the case study for today is Walt Disney. Now, I'm sure you know of Walt Disney. You probably have seen a Disney movie at some point, Pixar, Marvel, all these different things, right? Star Wars now, they own Star Wars. And so there's something that you've seen that belongs to Disney, I'm fairly certain. And of course, if you haven't heard of it, they also have a theme park called Disneyland and Disney World, which is kind of popular as well. And it's a pretty good moneymaker for them, right? So let's look at these guys. So split 8 times historically throughout the creation of this company and by the time that it went public, right? So the first one was in 62. So far out of all the case studies that we've done, this is the oldest split. Now, this is also the most unique split so far that we've done because it was 103 to 100 split. So if you had 100 shares, you would end up getting 103 shares. If you had 1,000 shares, you would end up getting 1,030 shares. So it's not this like crazy split, okay? All right. Next one was in 67, 2 to 1. That's kind of normal. 71, 2 to 1. 73, 2 to 1. 86, 4 to 1, okay? 92, 4 to 1. So far, these are like the biggest ratios, right? That if you have 1, it ends up turning into 4. 98, 3 to 1. And then 2007, another weird one. If you have 1,004, or excuse me, if you have 1,000 shares, you would end up getting 1,014 shares. If you had 10 shares, you would get 10.14 shares, okay? It's a weird split number. But okay, so this is the history of Walt Disney's stock splits. Okay, so now let's look at what their actual stock performance looks like historically. And so this is on Google. So, and I don't know exactly where, I think it's come from, it says New York Stock Exchange. So this is, I'm guessing, the earliest history that we have. So we can't go back to 67 for these guys. We're at 1981, which is our earliest. So 1981, and then so after 81, 86 was the first one. So if we go to, and so 81, we're at $1.20, right? 86, we are at, if we do July of 86, actually, what is this? This is March of 81, so let's do July or March of 86. So if I go to March of 86, okay, March of 86 is at 313. That's not bad. This actually, out of all the stocks that we've looked at so far, this has been like the greatest increase by the 80s. And so from 86, and this is actually like when we look at the historical performance of this is one of the stronger looking ones because if you remember Microsoft, it was pretty flat, like in between 80 and 2010. It was pretty kind of flat between, like, I would say between 90s and 2010. But anyway, so 86 was our first 4 to 1. And so that was March of 86, which was, let me remind myself again, it was 330 or 313. So that's March of 86, it's 313. Next one was in 92. So if we go to March of 92, the stock value has now $12.31. That's a pretty big increase compared to the other ones that we've had, but it's also like a longer gap. So that's fine. So 92, and then we're going to go to 98 now. So 92, we were at 12.31. 98, we are going to be at, ooh, that's nice, $36. Okay, so we went from $12 to $36. Not bad. And now the next one is going to be in 2007. And this is actually very interesting because it's like right before that giant crash that happened in 2008. So March of 2007, they did another split. And where is it? Right here. So we're at 34. So it wasn't really, it pretty much considering like whatever the increase was from 98, because it was actually, it even took a hit since 98. So the value of the stock dropped since 98. But then you have the crash that happened in 2008, 2009. But ever since then, their stock has increased fairly well. They had a little bit of a interesting point right here between 2015 and 2018. Pretty volatile at this moment. But then another increase, 2020 happened. It hit them really hard because there was the pandemic and there was the quarantine and the social distancing and all that stuff. And Disney took one of the biggest hits among all of the companies. Obviously not like hospitality and all these restaurants, and we can't compare it to them, but they had to close Walt Disney World, and Walt Disney World and Disneyland, all these places that they had were one of their biggest money earners and revenue generators. And so they had to shut all those things down. And I think even to this day, because this is 2021, we are in March of 2021, and they're still not opened from what I know. But I kind of don't go to Disneyland, so I can't be for sure about that. But I'm pretty sure that they're still not open. So they're still hurting, but they launched Disney Plus, and look at what happened. So this is really interesting what they've been able to do throughout their entire history and the way that they adapted to market conditions and what they did as a company. Now, as a stock, it's pretty interesting because, again, the company itself is a behemoth, and we're going to look at their market cap in a second. But the company itself is gigantic, so it's a pretty strong company if you're considering purchasing their stock. Again, I'm not a licensed advisor, so you got to go speak with a licensed advisor because you have your hard-earned money that you got to take care of. But just in case, that's what that looks like. Now, let's look at their market cap. Let me see if I can, how can I zoom in right here? Can I zoom in? If I do this, oh, there you go. Perfect, that's cool. All right, so 2006, this is the same era that we start with most of our other stock market caps that we've looked at. 2005, they were at 54 billion. So this is actually pretty strong compared to Amazon, compared to Apple. This is pretty strong. In 2005, they're at 54 billion. They experienced a pretty strong dip in their market cap in 2008. And this again happened with a lot of different companies as well because it was the crash. So it was kind of natural that it affected everybody. But the way that they recovered up until 2011, which was another, again, there were several market corrections. And then when you look at the history of market corrections, it typically takes every 7 to 10 years, maybe sometimes every 13 years, where you actually have a correction, right? So if this is 2008, 2009, you go forward to 2011, 2012, there was around this time, there was, and this is actually kind of like one of the shorter ones as well, but that was like a good 3 years where they experienced a gain and then they had a market correction. And then we have like another small market correction in 2012, and then you have another one that was in 2013, and then you have the one that I'm in 2015, and this is, look at this. This is a pretty big correction, and when we looked at their stock value, it also reflected this type of a pattern. It was pretty volatile in this era. But again, you're looking at a company that has been able to survive since the 60s. So when you look at the longevity of the stock, it's pretty amazing, and the longevity of this company. And in 2020, even though there was this giant dip that happened because of the pandemic, they still were able to recover, and they got their market cap to what? $360 billion. Compared to tech companies, I understand it's not even remotely close. But for a company that's centered around entertainment production, and it's like a theme park, really, when you actually compare it to other companies that are in this type of an industry, these guys have done extremely well for themselves. The acquisitions that they've made with the brand equities that they purchased, just really, really, really amazing what they've done as a company, and the leadership that took over after Walt Disney passed away, and just everything that they've done with this company is nothing short of amazing. So really interesting stock to look at, really interesting company to look at. And I mean, if you have any questions about this particular one, obviously leave it in the comments. And just in case you were wondering, you can do a simple Google search and find the listings and the schedules of all of the stock splits that are going to come up in the next year. So right now we're in 2021, and you literally see all the companies that are listed to have stock splits in the upcoming year, excuse me. And so this is a really, really interesting thing to see. And there's different, this is actually March of 2021. So I can even go to the next month and it'll show me what April of 2021 would look like, right? And then look, and you keep going and it keeps showing you. So it's nothing for June, nothing for July. Actually, you know what? There was another one that I saw. So if I go back, how many searches do I have to go back? April, March, and then we go one more. So there's market beats that we were just on the Fidelity calendar, but then there's the market beat calendar, and it shows you different stocks that are splitting as well. So there's actual scheduled splits that have been announced already, but then if you just do a monthly Google search, you can also find other splits that are announced. And when you look at the history, typically, I'm not saying all the time, okay? So you gotta, again, go do your own due diligence, do your own studying. But when you look at the performance of a stock after the split has been made, typically there's a lot of more investors that come and support that company. So the company as an entity becomes stronger. So it gives the company a better fighting chance to survive within the 5-year, 10-year, 15-year, 20-year period. But it also ends up the actual value of the stock ends up growing as well in the following 12 to 24 months. So this isn't for day traders per se, but if you're in the concept of buying and holding, it's not a bad thing to look at, the idea of stock splits and stock split calendars and different companies that end up doing it. So if you have any questions, again, leave it in the comments. If you have any comments, leave it in the comments. We would love to hear from you guys. And obviously, if we can, we will create videos to answer your questions. And if necessary, if it's something easy, we'll just answer it within the comments themselves. So that was the episode today for Stock Splits. My name is Arman Vakili, and I hope you guys enjoyed it. I will see you in the next episode.